Hello everyone. I, Dr. Namrata Srivastav, Assistant Professor of Economics, the Bhopal School of Social Sciences. Today we will discuss about the monetarist theory. First, we know about the founder of the monetarist theory and what they said under this theory. First, the founder of monetarist theory was Milton Friedman. It was an American economist, a leader of the Chicago School of Monetary Economics, and an advocate for free market capitalism. It is a part of macroeconomic theory, state that government can foster economic stability by targeting the growth rate of the supply of money. Under this policy, under this theory, they want if they increase the money supply evenly, they get the economic growth. Monetarism is an economic school of thought which states that the supply of money is an economy is the primary driver of economic growth. How? Because when the money supply increases, the labor income or the wages will be increasing. Means their capacity of purchasing power will be increased. So, the aggregate demand will increase and the result entrepreneur or a businessman they increase the supply or a production vice versa. Monetary policy an economic tool used in under this theory. Why they use monetary tools under this theory? Because when they increase money supply, the result will the price will hike. Means the inflation situation we can see in the economic if the money supply increases. Means demand will increases and they have and in short run we cannot produce more thing. So, what will the result? Demand is higher than supply and inflation we can see in the economy. So, in inflation they want to control increasing the interest rate. If they increase the interest rate, people deposit their money into the bank and we can say the saving will high because the interest rate of bank is high and the expenditure of the customers or a consumer will decline. So, automatically we can see the price will reduce. So, these tools used for the decline the inflation rate. Vice versa, other hand, if the deflation situation is there, so that time they reduce the interest rate. What will be the result? When the interest rate decline, borrowing will be cheaper. People they have borrow money from the market or the bank and enhance and use that money enhance their business. Under this policy, some small or a simple formula MV is equal to PV. If we can change the value of P is the left side, what will be the result? P is equal to MV upon Q, where M is the monetary supply, V is the velocity of money, P is the price level and Q is the quantity of goods and services sold. Some assumption of the monetarist theory. First, if all other factors remain static, an increase in monetary supply should cause an increase in the price level. Wages and price take time to adjust to change in monetary supply. Next is the government should increase monetary supply as a rate that match their increase in GDP so that price remain relatively stable. Market should remain relatively stable so long as a major fluctuation of money supply do not occur. Means they control with the help of monetary tools. Interest rate should be flexible so that they can account for inflation. Some importance of monetarist theory. Inflation control. Yes, as I discussed before, with the help of monetary tools, they can control the inflation with the help of increasing interest rate. bank policy, central bank policy also control the inflation and deflation, vice versa, with the increasing and decreasing the interest rate. Long term growth. If we know about this situation, this is the inflation situation, how we control, or the deflations, how we control, we can manage it for a long term imbalance, and we can growth adopt by the help of monetarism theory. Rational expectation, next point. Yeah, next importance we can say the rational expectations. When the consumer know about the inflation and a deflation situation, they can manage their expenditure, and in under this monetarism theory, they believe that a consumer is a rational. Next, some criticism and the limitation of the monetarist theory. First, assumption of money demand. Monetarism theory assume a stable relationship between the money supply and the demand, means the equality of that both the situation, which may not held true in the short run. In a short period, we cannot manage the demand and a supply of money. Second, criticism or a limitation of that theory, neutrality of a money. The assumption neutrality of a money remaining money only affects nominal variables and not real variable. Some economists argue that money can have real effect on economic activity, particularly in the short term only. Next, criticism or a limitation of that theory is time lag. Under this theory, they ignore the time lag. It can make it challenging for the policymaker to solve the economic fluctuation, and with the help of using tools they cannot control in a short run. Next limitation is limited scope of monetary policy. Under the monetary tools, you can know about the CRR, bank rate, interest rate, SLR, so many things. But in this policy, they discuss only the interest rate, means the scope is very limited. Next criticism is the rational expectations of the criticism. They said the consumer is rational. They know about how they expend and what is the mean of the expenditure. But the preference, taste, everything affected the consumer demand, and the consumer demand, we can say it is a factor of psychological. So many things they are affected. We cannot say the consumer is rational each and every time. So these are the limitation of the monetarist theory. That's it. Thank you.